Let's talk about the second part of this show, which is about your investments and the strategy that you should employ. It's always a good idea to diversify your portfolio. You've probably heard this said in the past by a lot of veteran investors, and there's a reason why they say this. You're talking about diversification by adding a variety in your portfolio in terms of asset classes. So here we're talking about equity, we're talking about fixed income, we're talking about gold, and we're talking about possibly real estate, but not necessarily physical real estate. So we'll talk about some of this in the second part of today's conversation. Joining me is Rohit Mattu, who's the National Head Retail at Axis AMC. Rohit, thanks so much for taking the time. And let's talk about this, because I was looking at the latest Amphi data, and very encouragingly, I think a lot of people are buying into the hybrid strategy, are buying into even the multi-asset strategy, which has meant very strong results, particularly over the last several months because of gold, but also it's a good thing because they're looking for diversified funds. What do you think about that?
No, I think, first of all, thanks a lot, Alex, for having me on the show. Actually, market has become a bit matured, if you say. In the past, what used to happen, people used to follow trends quite a bit. But then I think lots of financial literacy has made it a point that clients have become a little wiser, and there are lots of advisors or the partners who are suggesting those kind of plans to our clients. And that's how you see this, again, lots of interest coming into multi-asset. As a strategy, obviously, multi-asset is something, it's an all-weather strategy, because past 25-30 years have told us that not at all points of time all the asset classes run in tandem. Usually there are contra plays which happen. There was a time period when equity used to do well, but at the same time probably that time gold will not do well. When gold does well, sometimes equity will not do well. So it is always prudent that clients make that shift to the multi-asset strategy, because that's where it becomes an all-weather strategy with them. The volatility is lesser, the risks are taken care of, because when one asset class doesn't do well, something else is working for you. So it's an engine, it's a three-paced engine where one of the engines is working and ensuring that you are taken care in terms of the return expectation, and at the same time the risk volatility which otherwise you pay.
Yeah, let's talk about some of these aspects in a little more detail. And I want you to look back, particularly over the last 1 year to 3 years, and discuss the importance of what you just said in the context of movements of these asset classes. Because on the one hand, you've had gold, which is a decadal story, if at all, and quite a bit of that has happened over the last 5 years as central banks around the world have started buying more of this asset, and they've been in the process of de-dollarization seemingly, and that has pushed the prices much higher. And the Indian household has benefited, and so have investors into multi-asset portfolios as well. But there's also fixed income, where you've had a significant benefit of the monetary policy shifting to the downside, and there's even more room in the engine or fuel in the engine for a bit of a pop heading into the next few months. And all the same, you've had equity that's not done particularly well over the last 12 months. So put all of this into context.
Yeah, so you're right, Alex. For example, let's take example of gold, for example. Everybody is talking about gold for last 1.5 years has done significantly well. But there was a decade from, say, 2010 to 2020, the gold average CAGR was just 3.7%. So it didn't do anything at all. Last 5 years, the CAGR is around almost 14%-ish, because of obviously a stellar performance of almost 50+% last 1 year. At the same time, if you see from FY22 to 24, Indian equity markets had a brilliant run, bull run. We saw broad basing of market. We saw all the sectors, most of the capitalizations doing really well, small caps doing really well. But then again, we've had last 1 year, which has been very, very tough. At the same time, on the fixed income, as you said, because of the monetary policy, because of the way our inflation has been brought under control, and still inflation as we talk is around 2%, which gives some more headway to the central banks to do some policy intervention. But our belief is now probably the long duration play is not there to play. But then, yes, there is still some headway which we can play because of the monetary policy easing. So we've seen so many times that markets, one leg of the market does exceptionally well, some other leg of the market doesn't do well. How do clients balance this? For the clients, it's a big dilemma when to get into which asset class. It is also a dilemma for clients sometimes whether they should invest in small cap, large cap, mid cap, which are the themes which will do well. And that's where multi-asset kind of a strategy plays really, really well, because it's the fund manager who is ensuring that he's switching within the asset classes without putting too much of tax incidence. I think that's so one of the very, very important factors here. It becomes a very tax efficient way of investment. And secondly, there's an expert who's looking at the markets almost on every day, every single day basis, and there's an expert who's trying to take that decision on your behalf. So that gives more credibility to that decision.
I'm looking at the sheet of the Axis Multi-Asset Fund, and there is allocation to gold ETF, there is silver as well. I'm just wondering what the strategy is currently and how the fund house is looking at the allocation strategy as we stand in November of 2025.
So as of now, our gold plus silver allocation is around 15% odd. Looking at where the market is, we may not be wanting to increase that allocation as of now. But then there is still, we believe that gold definitely there is lots of leg room to do well over next few years, because as you said, there is lots of talks on de-dollarization, lots of things happening. Central banks wanting to wrap up their gold reserves against the currencies. So that ways. We still think that gold should do well over a period of time. But then looking at the recent uptrend in the gold, obviously we are a little skeptical. We want to take a pause there for some time. We are happy with the allocation as of now, what is there. So the commodity will be around 15-16% as of now. But we are coming up with one more FOF multi-asset fund where it will be very dynamically managed by our fund managers. There we can go up to 35%. Obviously, not that fund managers will go straight away to 35%, but that's the leeway and dynamic approach which we can have there in the multi-asset FOF category, where we would be taking a longer-term view on the asset and trying to see where we can take the opportunity to ramp up the numbers there.
And the tax incidence will be easily manageable in an FOF kind of format, wouldn't it?
The best part, some of the key advantages of a FOF structure is one, you're not relying only on one fund manager to take calls for you. Because it's an FOF, the fund managers can go to the best fund managers, best funds within the AMC and try and see how they can diversify the risks there. They can also play various themes on the equity side of it, right? And whenever they feel that markets are overheated, or the debt side of it is overheated, or sometimes the commodity side of it is overheated, they can quickly shift. For example, on the equity side, we can come as low as 10%. Not that we will, but then there is an opportunity that in case we feel that markets are not doing that great, that the dynamic flexibility is there that I can come down to 10%, and still clients who hold on to the fund for more than 2 years, their taxation will be 12.5%. So that's the big advantage you have, that you can play very, very dynamically there. You can play various themes within the fund because there's no allocations as such, because in any of the other active equity funds, you have to go with the fundamental attributes of the fund. If you have a mandate to invest in large caps, you have to be majorly into large caps. You can't deviate from that. Correct. But a fund structure gives us that opportunity and that flexibility that we can maneuver ourselves between debt, equity, and commodity, which makes it a very, very efficient tool for long-term investors.
Okay. Maybe the next time we speak, we'll talk a little more about that. But I do want to ask, and this is a counter question, right, Rohit? A lot of people, particularly in the equity markets, tend to look down their nose at a multi-asset strategy, right? They say that, look, we believe in the India growth story and we want to be wholly equity. And this is coming from families that have invested in equity for the longest time. So they say, why should I shift out? If they have to rotate, they might rotate from the broader end of the market if they're feeling conservative to the large cap space. They say that they will be able to conserve their capital on that front. Why do you think that having a certain allocation, even if it is 10 to 15 to 20% into fixed income, is absolutely necessary to have?
Alex, the good part about this strategy is that when you backtest all these models, what it gives is that your stand deviation is almost half of what a normal diversified equity fund will have, and still the return expectation is maybe 100 bits less than a diversified fund. So you are taking almost half the risk of a equity fund and making returns which is almost as similar to an equity fund. That's why it makes very so it's as I said, it's an all-weather investments which a client is doing, and it also gives the exposure of the commodities, which generally we tend to sometimes miss out because we don't try to time gold as an investment. Obviously, as a jewelry and as a household jewelry, we keep buying that, but then it gives a great opportunity for people who are not very aggressive. And there is a segment of client. Believe me, there are lots of clients who are first-time investors. India still is at what nascent stage. We are just 5.35 crores of investors who are unique investors who are investing in equities. There are lots of first-time investors. There's lots of euphoria coming in from women investors, and almost 50% of our new clients who are coming into the markets are women. So for them, probably this is the best way to start their investment journey so that accidents are lesser, because volatility will be lesser, the consistency of the returns will be there, and there is some engine working for you at some point of time, so you don't have to wait. For example, somebody who had invested only in equity last, say, September, he would be sitting either on a 1 or 2% profit or maybe in losses also. So whether a new client who has come into the market in September 24 would want to be in this market when he has seen that he used to invest in FD, for example, to make 5-6% and he's not made anything, maybe he'll dissuade from the market and feel that no, I'm better off being
good point. That's a good point.
I would say there they should come and invest into multi-asset, because this will give them a good experience of participating in the growth trajectory of Indian markets.
Absolutely.
And India as a growth story. At the same time, they don't have to go through the same kind of volatility, same kind of risk. So the experience is better and the longevity of that client will be better.
You made a strong case, and I think the next time somebody says, I have a 100% equity portfolio, I know what to tell them. Rohit, thanks so much for taking the time. Pleasure speaking with you.
Pleasure is all mine, Alex. Thanks a lot. Bye-bye.
All right, well, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.